Welcome to this Just Share panel discussion, Divest for Good, Making the Change from Fossil Fuels. St Mary Le Bow is an excellent place in which to have this discussion, because this is a church that practices what it preaches in matters concerning the environment and energy consumption and climate change. So thank you to the church for hosting us today. Just Share is a coalition of churches and charities committed to global development and social justice through free public debates and lectures within the City of London and beyond. Just a word about timings. We started now at 6:05. We're finishing at 7. So we need to move swiftly, and we've allowed about 8 minutes for each of our 3 speakers, whom I will introduce presently. Then we will have a time for questions, coordinated and moderated by me. And we aim to conclude at 7 p.m, after which you are welcome to stay for refreshments, fair trade refreshments. Now a little bit about the subject. The fossil fuel divestment movement is growing fast, and tonight we're here to discuss the ethics, politics, and economics of this important topic with a panel of specialists in campaigning, finance, and investment. There is no question now, increasingly, that climate change is the most wicked and difficult and complex problem that we have ever faced as a human species. Today we are discussing just one small part of that immense problem, one jigsaw piece which interlocks with many others in the entire picture. But we must not shirk it, because it is important and it is growing in its influence on many people and organizations. There are many wider issues which we won't be able to tackle today about energy policy in general. But I have brought with me my copy of 4 different books, which are just examples of the kind of background reading which is available if you want to study more widely. And I'll tell you what they are. I entirely agree with some of them, but not all. But I'm not going to tell you which in order not to seem prejudiced. But here they are. The Energy of Nations by Jeremy Leggett, and he is a colleague of one of our speakers today. The Burning Question by Mike Berners-Lee and Duncan Clark. This Changes Everything by Naomi Klein, recently published. And finally, Daniel Yergin, The Quest, which is about energy in general. You're welcome to glance at them if you wish afterwards. They're full of my bookmarks, so please be careful about that. Now I'm going to introduce our speakers. Firstly, we have Ellie Roberts. Ellie is a campaigner for Operation Noah, a Christian charity providing leadership, focus and inspiration in response to the growing threat of climate change. She runs the Bright Now divestment campaign for Operation Noah, and you can read more about what she does in the leaflets that you have been given on coming. Mark Campanale is the founder of the Carbon Tracker Initiative, and he conceived the Unburnable Carbon Capital Markets Thesis. He commissioned and was the editor of the breakthrough Unburnable Carbon, Are Markets Carrying a Carbon Bubble report, which I also have a copy of with me today, and I think it's updated from time to time. I've got the 2013 version. You can also read more about Mark in your leaflet. Finally, Seb Bilo is Head of Sustainability Research for WHEB Group and leads the integration of sustainability analysis within the investment process, as well as overseeing engagement activities. What are these 3 speakers going to be telling us about? Ellie will first speak to highlight the ethical basis for divesting from fossil fuels, why disinvestment is the right strategy for dealing with fossil fuel companies, for our dealings with fossil fuel companies, and why this is particularly the right approach for the Church as an ethical investor. That is what Ellie will be arguing. Mark will then go on to discuss if the fossil fuel industry is to change and to contract to keep within the internationally agreed target of 2 degrees warming this century. Where does divestment fit in that strategy? Is it the right strategy? And what should investors do or civil society groups do to forward that target? Finally, Seb will conclude by focusing on discussing a range of low-carbon investment opportunities that already exist in the equities market, and will try to describe some of the research that's been done to show how disinvesting from fossil fuels doesn't necessarily have a negative impact on returns. So I'm looking forward to hearing all that our 3 speakers have got to say about these topics, and then we will proceed to questions from yourselves in the floor. Thank you very much. And first, I will hand over to Ellie, who is going to take the rostrum and address you first. Thank you.
Hi, thanks very much. Is that okay on volume? Should I just, how's that for, yeah? Okay, hi. It's great to be here this evening. My name's Ellie. I work on Operation Noah's divestment campaign, which is called Bright Now Towards Fossil-Free Churches. So as a campaign, we're calling on the church to disinvest from fossil fuel companies and to take a leading role in the national debate on the ethics of fossil fuel investment, and to support the transition to a low-carbon economy by using its investments to support renewable energy and other clean technology. So we work as part of the broader divestment campaign, which is challenging individuals, organisations and institutions, including local authorities, religious institutions, universities and health authorities, to move their money away from fossil fuels and to reinvest it in renewable energies. We launched our campaign in September 2013, and I think since then we've seen an amazing amount of momentum gathering among churches around the world around the issue of disinvestment. So churches and faith communities who have already decided to move their money away from fossil fuels include the World Council of Churches, the Church of Sweden, Quakers in Britain, the Uniting Church in Australia, and the Presbyterian Church in New Zealand. So this evening I'd just like to look at the question of why these churches, congregations, faith communities are deciding to move their money away from fossil fuels. I'm going to look at some of the ethical arguments around why we launched the campaign and why we're calling for disinvestment, and then look at the role that we hope ethical investors such as the church can play in meeting the climate challenge by disinvesting. So just to start by outlining some of the key ethical motivations for disinvestment. I think one of the most important ethical arguments around this issue is the urgency of the science and the real contradiction between what the science demands and the current business as usual business strategies of the fossil fuel companies. So at the moment we know that we have a relatively small window of opportunity to hold global temperature rise below 2 degrees. We also know that if we want to meet this challenge to hold temperature rise below this level, we need to leave a vast majority of the world's fossil fuel reserves in the ground. We also know what the impact of climate change is at the moment for some of the world's poorest and most vulnerable communities, and these are the communities who've done the least to contribute to the causes of climate change. And we know that future generations will suffer worse impacts if we don't take sufficient action now. So I think given what we know about climate science and the impacts of climate change, there's a real contradiction between this and the business strategies of fossil fuel companies, which at the moment is based on ever greater exploration and extraction of fossil fuels. So a good example of this is ExxonMobil. Alone as a company, they spend over £400,000 on exploration of new reserves every 10 minutes. As well as this, we're seeing more use of unconventional extraction methods and exploration of unconventional sources. So, for example, deep water drilling and tar sands. So there's a real contradiction between what we know we need to do from climate science and the strategies of the fossil fuel companies. And I think investors have a really sort of crucial opportunity in this to publicly challenge the ongoing and increasing extraction of fossil fuel reserves in the context of climate change by using their investments to make a public statement about this contradiction. So these are some of the ethical motivations for us, why we launched the campaign, why we're calling for disinvestment. Now I'd just like to look at what role we believe the church can play by disinvesting, as well as what role other ethical investors can play. So as I've said, I think the divestment movement as a whole, in its sort of outreach to many different kinds of institutions, is really challenging the contradiction between a reducing carbon budget on the one hand and increasing use of fossil fuel reserves on the other. By disinvesting, the church and other ethical investors send a really clear statement to fossil fuel companies that they want them to change their business strategies now, or they risk losing investment. And I think as bigger institutions and funds start to engage with the divestment movement, so for example, in September, the Rockefeller Brothers Fund, the wealth of which is founded on oil, disinvested a huge amount of money from fossil fuels. And I think as this starts to happen more and more, fossil fuel companies will really feel the challenge more strongly. I also think that in disinvesting, it's not just a message to companies, it's also a message to governments, that civil society and the private sector is ready to make changes, and that they also want to see changes in the way government relates to fossil fuel companies. So global subsidies for fossil fuel companies are still huge, and they still far outweigh subsidies for renewable energies, despite the transition that we know we urgently need to make. Fossil fuel companies also spend a huge amount of money each year lobbying governments. Oxfam published a report recently that found that fossil fuel companies had spent over 44 million euros lobbying the EU last year. I also think for the divestment movement, the coming year is a really crucial opportunity for investors to have a real impact on the action that governments take on climate change. World leaders will negotiate a new agreement to limit global greenhouse gas emissions at the end of 2015 in Paris. And I think by disinvesting over the coming year, investors can really signal their support for this agreement and their readiness to transition away from fossil fuels and towards a low-carbon economy. Finally, I'd just like to say that we can look at historical divestment movements to see how much influence they can have in bringing about change. So previously, the church and other investors played a huge role in the anti-apartheid movement, and divestment was really crucial in bringing about change. So those are some of the ethical motivations for disinvestment and the role that we hope churches can play by disinvesting. In the last couple of minutes, I'll just briefly look at some of the challenges that the church faces in considering disinvestment. I think it's not a straightforward issue, and it does raise some really important questions for investors. One of the key challenges that we often hear from churches is a fear that by disinvesting, they'll see a negative impact on their returns. I think we're seeing more and more that studies are showing portfolios not invested in fossil fuels can outperform traditional portfolios that are invested. I think other speakers will expand on that, so I won't say any more. We have just written a paper looking at the financial case for disinvesting and outlining some opportunities for reinvestment. And this is available at the back of the room if you'd like to read any more about that. And I'll leave it there for now, but I look forward to taking questions. Thank you.
Thank you very much, Ellie. That started us off very nicely. And now I'm going to introduce Mark to speak to us on behalf of Carbon Tracker. Thank you, Mark.
Thanks very much for that kind introduction. Carbon Tracker, we're a small not-for-profit organization. Our first big funder is the granddaughter of John D. Rockefeller, a woman called Eileen Growald. When I set it up, we recruited people from the City of London and from Wall Street who spend their careers analyzing the oil and gas industry and the coal industry. We're a team of experts who we just analyze and study the trajectory of how capital is flowing into the expansion of the fossil fuel marketplace. Why is this so important? You won't be able to see really in too much detail here, but what it lists on the left is some of the largest companies in the world, which are oil companies, with ExxonMobil sitting there on the top. It's so important, it's a trillion-dollar, multi-trillion-dollar industry, that the wealth of countries and the wealth of pension funds and investors is tied up in these corporations, and so it's important. I had just one question that I wanted to answer when I set up Carbon Tracker, and we coined, myself and Nick Robbins coined the phrase the carbon bubble and unburnable carbon, was in my role as a fund management organization, I was seeing new capital raises to expand the fossil fuel sector every day, every week, at a time when there was more and more news about climate change. And somehow this didn't ring right. And so what I decided to do is, with a colleague James, is to take the world's largest coal, oil and gas companies and add up their reserves and find out what would happen if we were to burn it all. And there we saw the disconnect, and I'll show you in a few graphs in a minute, where we coined the phrase the carbon bubble. And then Bill McKibben of 350 wrote his amazing article. If you like good writing, go away and download Climate Change, Terrifying New Math by Bill McKibben. It's the most extraordinary piece of writing. Bill McKibben, it's Climate Change, Terrifying New Maths, in that well-known magazine, the Rolling Stone magazine. It's a terrific read, where he went on to make and build the arguments that then led to the fossil fuel divestment movement. So very simply, what is the carbon bubble and why is it important? What we know from the science, and I'm not a scientist, is that when you burn coal or oil or release methane, or principally if you release the CO2 gas, it stays in the atmosphere for hundreds of years. And what you see there is a very rapid spike in emissions and the accumulation of CO2 in the atmosphere. And the scientists tell us that we have the highest proportion of CO2 in the atmosphere not seen for 800,000 years, which gives us our problem. And from that, we can develop the idea of what we call a carbon budget, which is how much CO2 can we release before we see runaway climate change. On the right-hand side in the red is all the known oil, coal, and gas that sits underground. And what we have that's on the right. On the left is we have a series of scenarios of how much more CO2 can be released. And that gives us the idea of a carbon budget. And the key figures there is there's 2,600 gigatons thereabouts of CO2 locked up in the Earth's crust. And on the left, we can only burn about 1,000 gigatons. And it's the disconnect between the two is the problem. Because most investors, dare I say, most investors think that we can burn all the coal and all the oil and we don't have a problem. That shows the trajectory of emissions and what climate change outcomes are likely given the current trajectory, which is the orange, and where we really need to be is in the green to stabilize emissions. And there we have the time frame. I want you to look at the period 2020 to 2040, and I'll come back to that. I think there's some that people in the city, investors who think this is an issue which is for 40, 50, 60 years' time. What we know is actually this is an issue for today, it's an issue for the next 10 years, and all the crucial decisions are going to be made now by investment institutions over the next few years. So what is the bubble? So we looked at all these top listed coal and oil and gas companies, and we looked at it around different exchanges. And what those round circles are is just where this money is invested and where the coal and oil and gas, the financing of it sits. Moscow's the big one on the right, London's the one in the middle, and New York is the one bottom left. The decisions are made in the City of London. If we could move on to the next one. We decided to look at where is all the new money going to go, and what you see happens. The dark grey is actually coal, and the dark blue is oil. What happens in London? London becomes the coal financial centre of the world in the next 10 years. City financial institutions are backed up to continuing to support coal investment, and there we have the challenge, because we're going to develop enough carbon dioxide through coal, oil, and gas to take us way beyond 3 or 4 degrees. So what is the bubble? The bubble is the red is the 1,500 gigatons of what's already been financed. It's the reserves owned by your Shell and BP and your Glencore Xstrata. The blue is just the reserves, which is close to production and will have a certainty of production. And the green is the allocation of a carbon budget to stay to 2 degrees. How much can you burn if you're a listed company? And the bubble is the difference between the red, which is what's being financed now, and the green, which is what can be burnt over the next, decades to come. And that really, in simple terms, is what the bubble is, and it's a disconnection. So there's the fossil fuel industry is worth around 4 trillion. There's the figure in the red on the left there that finances the coal and the oil industry, and it generates earnings back to investors. And in the case of interest, it serves in the billions, and then dividends, 126 billion goes in dividends. So it's a fundamentally important sector for investors, and this is how it works. So let's have a look at some timelines. Based on current emissions, based on what we model investors are likely to finance over the next 10 years, there are the trajectory of emissions, and there are the timelines. And I want you to look at those 2 red dots. Based on current emission scenarios, we believe that we will break through the 2 degrees and then shortly after 3 degrees, somewhere between 2031 and 2045. So in the next 18 years. And to put this into context, last time there were 3 degrees of warming. This is a global average mean rise in temperatures. That's a figure that was given to me, or a statistic, is that there were camels in the Arctic was the last time there was a 3 degrees. And the current trajectory, we go beyond that to 4 degrees or 5 degrees. And this all happens, well, actually, we don't see the physical consequences for many, many years into the future. But in terms of the emissions, we can see that it's within the lifetime of many people that we see us breaking through these emissions. We may not see the physical effects for 20, 30, 40, 50, 100 years. We don't know, but clearly the decisions on emissions are to be made now. So what do we need to do? Well, we're focused on what the city can do, what investors can do. And the first thing to accept, and I think this is a difficult point for many investors, is that this is a sector which is perhaps one of the largest and most significant investments in people's portfolios will be companies like Shell and BP, is that we have to decarbonize and contract the fossil fuel sector. So how do we do that? The first thing we have to do is to stop investing in developing new projects, the kinds of arguments that Operation Noah and others are making. So what Carbon Tracker is doing is we're providing the toolkit for fund managers and city institutions to work out which of these large fossil fuel projects need to be cancelled. So how do we do it? Well, the analysts, we've looked at 8,000 oil projects around the world, and we've looked at all the major coal projects. We've bought the data off the oil industry, and we're beginning to grade individual projects, fossil fuel projects, into 3 groups: losers in a climate-changing world, businesses at risk, and then those which may survive in the bottom left. 1 minute. Okay. And so we've created what we're calling a cost curve, which is difficult to explain, but I'll try and explain it simply, is if you follow break-even prices of oil and equilibrium economics, what the red bars across the blue line show you is the supply of oil and gas at different prices. And if you're a company producing oil in the bottom left-hand corner, you may be a survivor in a 2 degrees world where you have constraints on the demand for fossil fuels. But if your project's on the right, then you're likely to be a loser. And here, we've mapped all the oil companies, which are listed on the left here, with how much they're going to spend. So Petrobras will spend $450 billion on finding more oil in the next 10, 20 years. And we then work out which of the projects are most at risk. This is a tool that we're now using with large financial institutions who are beginning to engage with the fossil fuel industry to try and stay within the budget. So we're therefore really, as a tool, my last 2 slides are what's really driving this. Today, I don't know if you saw the announcement, but Norway's largest pension fund manager, KLP, announced that it's decided to sell all the coal from its client portfolios and to start to begin the decarbonisation process. In the UK, I'm not really aware of too many pension funds that have really made these types of announcements. One of the drivers is the fossil fuel divestment movement. When I was in New York, somebody built a carbon bubble showing the horns of the bull in Wall Street and the bubble being burst on the horns, which to me symbolizes really how the movement to divest has really come home and beginning to influence major financial institutions. Thank you very much.
Thanks, Mark. And now I'm going to finally hand over to Seb on behalf of WHEB Asset Management. Thank you, Seb.
Great. Good evening, everybody, and thank you very much for the invitation to come and speak here this evening. My name is Seb Bilo, and I'm a partner and head of research at a company called Web. We're a small investment manager focused on sustainability and investing in environmental and social themes. So I'm going to focus my remarks, and I'm going to try and stick to my 8 minutes in order to avoid the threatening presence of Brian behind me there at the end. And really just focus on three points. There are three kind of common concerns about investing in low-carbon projects, companies. So if we could just slide, yeah, there we go. So these are the three common concerns that I think exist out there. The first is that, well, it's all very well, but this is a very small sector, and it's very sort of early stage, small businesses. The second one is that you have to compromise on performance. If you want to be concerned about this, then you can do it for moral reasons, but it's going to cost you. And then the third one is that, well, maybe it's okay, but actually this is just for growth-oriented types of investors. And if you're looking for an income or a yield, then this isn't an area that you can invest in. And I think all three are flawed. And I'm going to deal with each in turn. So just in terms of that first question or first concern, actually there are a whole range of different ways that you can invest in low carbon. It's not just the renewable energy that we all hear and think about. There are a whole range of different areas that qualify in terms of low carbon. This little picture on the left is the way that we think about it at Web, which includes some social themes as well, like healthcare and education. But in terms of environmental themes, we have clean energy, of course. It's a small part, but it's certainly there. We have areas like what we call environmental services, which is pollution control, waste management, those sorts of businesses. Resource efficiency is a very big theme. Lots of companies involved in making more energy efficient lighting, insulation for buildings, automating manufacturing processes, more efficient manufacturing equipment, all sorts of ways that you can invest in more energy efficient or more resource efficient businesses. Water management's another one, and sustainable transport, of course. Electric cars, bicycles, even bus and rail would fall into this category. So it's a much bigger universe of businesses than many people realize. And it's not just us saying this. There are other organizations out there that have tried to develop products in this area. HSBC have a climate change index, which is composed of 360 companies with revenues of nearly $500 billion per year. So these are big businesses that are involved in these sectors. FTSE have produced an enormous piece of work called their Low Carbon Economy Database, and they found nearly 2,000 companies that have some level of revenue associated with low carbon products. That can be, to be honest, minimal, but nonetheless, 2,000 companies out of an investment universe of 9,000, which is essentially 98% of the world's market cap. 21% of those businesses do have revenue from low carbon products and services. And then our own universe of 1,000 companies that we've qualified in this theme all have a market cap of more than $200 million. So these aren't small businesses. These are established businesses that are making good money and represent good investments. Just two other charts. I'm sorry that you perhaps can't see these very clearly at the back. Ellie referenced these studies as well. This is a study from FTSE, which has developed a developed markets index, ex-fossil fuels, so stripping out the fossil fuel companies. The two key lines here are the dark red and the light blue, and you can see that the dark red, which is the ex-fossil fuel index, has outperformed modestly, but nonetheless outperformed the index which has fossil fuel businesses in it. And that's over 5 years, and it's outperformed on a 1 month, 3 month, 5 month, year to date, 1 year, 3 year, and 5 year basis. So, certainly you aren't looking at underperformance in this case, you're looking at very moderate outperformance. The other similar study comes from an organization called Impacts, and they've looked at the MSCI World Index, which is an index of the world's largest businesses, and then they have done the same thing. They've stripped out the fossil fuel sectors, And the blue is the one without the fossil fuels, and the green, perversely, is the one with the fossil fuels. And you can see there again, it's outperformed modestly, but it's certainly not having to pay a penalty for this. The volatility is a bit higher for those of you who understand that, but it's actually, the information ratio is positive, which means that actually you are getting a good product there, good outperformance. So those two studies really show you that really from disinvesting, you're not having to pay a penalty. My next chart, which is based on the universe that we've developed at Webb, shows sales growth from those companies that fit our universe, that fit these low-carbon themes, compared to the MSCI World Index. And you can see in this chart that over 5 years, sales growth has been significantly greater in companies that fit the theme, so the sort of positive investments, companies that are actively doing good from an environmental point of view. And again, 1 year forecast sales growth is also significantly better than the MSCI World. So there's really there's no reason why you should suffer a performance penalty by not investing in fossil fuel businesses. So that's the first concern, the first two concerns really about, there are lots of businesses, they are big, and you don't have to suffer a performance penalty. The third concern that people often raise is, well, that's all very well, it's just about growth though, isn't it? You can't get any yield or income. And actually, in a way that is true, but less and less so every month, really. And the examples that I give here are the growth in so-called climate and green bonds. And these are bonds that are issued. Climate bonds aren't necessarily self-labeled as being low carbon. A lot of it is rail stocks. But there are over $500 billion worth of climate bonds that are outstanding on the market today. It's small. There are over 1,000, I think that's right, 1,000 trillion, is that right? No, 100 trillion, sorry. So many zeros. Anyway, an awful lot of money issued in outstanding bonds. 500 billion isn't a huge amount of that, but nonetheless, it's still a significant amount of money. And then green bonds, which are expressly labeled as green bonds. Again, this market is absolutely going great guns. I mean, they're expecting to do $40 billion worth of green bonds this year, $100 billion worth of green bonds next year. So it's proved to be an incredibly attractive and popular market. And then the other thing, which I think people perhaps haven't appreciated, is that increasingly we're seeing these things called yield companies being launched. Listed companies that basically buy up renewable energy assets and pay out a very nice yield, very nice income. 15 of these businesses were launched over the last 2 years in the US and Canada, and we have 3 in the UK, and they pay out a yield of between 5 and 7%. So it's a good investment for income, for investors looking for an income. Shell, by the way, just pays out 5%, BP is 6%. So it's in that range of dividend yield. And then finally, there are a whole range of other asset classes as well that I haven't had time to talk about, from green property to forestry businesses that also can be considered, given the right criteria, to be low carbon in various ways as well. So this isn't just about growth. There are other ways of investing in this sector as well. So just finally, and I've got some animation which probably isn't going to work here, but so the 3 points that I started off with, that the low carbon sector is small and early stage. Well, not at all, actually. Au contraire. This is a sector which is well established. There are very large businesses that you can invest in this sector already today. The second concern is that low carbon investments require investors to compromise. I think that's absolute nonsense. And actually, you should expect to deliver equivalent or better performance by investing in this sector. And then finally, as I've just said, this isn't just about growth. There are other ways of investing in this sector as well, which generate yield and income as well. So thank you very much.
Thank you, Seb, and thank you. Sorry. Thank you to all our speakers. We now do have 20 minutes for questions, so please put your hands up, and when I see how many there are, I'll decide whether it's going to be one by one or 3 at a time. I think we can take three three together. First, the gentleman in the front row.
Thank you, firstly, to our panelists for a very interesting presentation on each of their parts. Our discussion today is very much focused on finance, but to go back to the books that were raised at the very front and to paraphrase Naomi Klein, do you think capitalism as a wider system is compatible with a livable climate?
Okay, now the lady in the green suit.
Hi, I've got a question for Mark from Carbon Tracker. Hi, can you hear me? Okay, I've got a question for Mark from Carbon Tracker. You mentioned KLP, who today announced it was divesting from coal, but it also said that it rejected the stranded assets debate, which you promote, and it was going to maintain its investments in oil and gas. I just wanted your reaction to that.
Thank you very much. And gentleman over there.
Hello. Am I allowed two questions?
I'm sorry?
Two questions.
Just one, please.
There's a book I found in the LSE bookshop just now, and it was second edition by, I think, someone who ran in the London School of Economics. And the blurb on the back said, all the new green ideas meet up to something substantial. You know, they haven't got they fall over. And
could you speak up, please, because there's a drill behind me, so I'm struggling to hear you, actually.
New green ideas fall over. It needs a much more substantial kind of look at it, and his book is on that.
So are you saying that we need a more substantial
look rather than just, you know, new ideas?
And who is your question particularly addressed to?
I think it's you, really, because you presented the 4 books, and this is another book.
All right. Okay, I'll attempt to do that. But first, we'll pose the question about capitalism in general. Would anyone like to address that?
I mean, you know, I don't think. I mean, there's a question about growth and whether ultimately, you know, at a sort of philosophical level, whether infinite growth is possible on a finite planet. And there was a quote from, I can't remember who, Jeremy Grantham was quoting him as saying, you can only believe in infinite growth on a finite planet if you're a madman or an economist. Which, you know, I'm not sure that's totally true. I think you can grow. We can become much more intelligent in the way that we use resources. But the thing is, there's nothing else. There's no other equivalent system that's really going to deliver benefit to people on a global stage. I think capitalism absolutely has to be the solution. But we just need a much more intelligent form of capitalism that recognizes these limits that we see in front of us.
I just really agree with what Seb said, and just add that I think it's not necessarily that capitalism isn't compatible with a world without climate change, but I would add that I think we need to prioritize many other factors alongside growth, and we need to see them as important, if not more important. So we need to look at well-being, we need to look at how we use resources, we need to look at the...
Thanks. Now, what about the question regarding KLP instead?
Is that if you dig something out of the ground and it costs you £1 and you sell it for £100, you've created wealth. Now, that's what's happened with the old coal and gas industry. And when that comes to an end, we're going to have to think very hard at what we're going to use to replace it. Sunlight is free. Can we capture wealth from the sun? And I think the real problem we've got is in liquidating the planet's natural resources, we've created a huge problem for ourselves, whether it's deforestation or overfishing in the sea or the use of fossil fuels beyond what's safe to burn. And so I think how we move to a more sustainable use of the planet's resources is a real challenge. And I think looking at the timing that we looked at on the charts earlier, I think we're running very quickly out of time on this, and it's difficult to see how we can stop fast. And the debate about capitalism's contribution to it, we've built a system based on these principles with the Earth has no limits, and I don't think we're going to get on top of them really fast enough, unfortunately.
Thanks, Mark. Now, what about the question regarding KLP and specifically stranded assets?
Okay. Yes. Now, If the carbon budget to 2 degrees is only between 565 gigatons and 750 gigatons, depending on how you calculate it, and there are resources listed on the stock exchanges of 1,500 gigatons, that would suggest that around half of the resources would be stranded in a 2 degrees world. Now you can go through 2 degrees and go through 3 degrees and it won't be stranded. So it's a scientific question. They may be arguing that it will get burnt anyway, and who's to know? Let's see what happens. On the financial side, we recently produced a piece of work that said around 90% of the oil projects in Canada, the tar sands projects, are stranded where the price of oil is below $95 a barrel. Now, we already know that oil's at $80 a barrel, so most of those projects are uneconomic. And in our use of the word stranded, those projects are economically unviable and will become stranded. So I'd be interested to see further what KLP's rationale is for coming to that conclusion. I'll have to ring up and ask him.
Thank you. I think I'm going to try and say something about the third question at the same time as posing follow-up questions to the others that we've already had. I agree that we need to take a wide, and I'm not sure if I quite understood the question accurately because there was a drill behind my ear, so I didn't hear clearly. It wasn't your fault. You're right, we need to look at these particular questions in the context of a much larger understanding of climate change and its implications for society and for socioeconomics and for politics, that we need to see the synthesis as well as the analysis of individual particular issues. And I can, without going into a long disquisition about the whole subject of climate change, I can only agree that we do have to understand things in their context. And I would go on really to follow up about some of what's been said here, because I think that there is a rather close relationship between the way you see the fossil fuel industries behaving and the wider question of social inequality, which has come to the fore in the last few years, particularly since the credit crunch. There's a term that economists use, which is rent-seeking behavior, that part of the rationale of capitalism is that individuals are seeking to inflate their own source of wealth by taking possession of and gaining control of and maximizing the size of particular assets, which may therefore be overstated or artificially inflated in one way or another, and to gain a monopolistic position in relation to those. And I think that there is a lot of this underlying the business model, as it's been described, of the fossil fuel industry. There's another particular term that's used, which is the reserve replacement ratio. And some of our panelists might like to say a bit more about this. But the principle is that in order to be seen as viable by investors, fossil fuel companies have to make sure that the amount that they have left in the ground, proven resources that is left in the ground, which they plan to exploit in the future, is at least equal in value to what they are currently extracting at the moment. So this means that they are always continually struggling to extend their horizons further and further into the future in order to make sure that as a particular oil field or gas field is used up, that something else has already been proven which at least equals in value what they are now beginning to exploit. And this is a very, very powerful dynamic in the oil and gas industry. And I can't pretend to say how that can possibly begin to be broken or how new business models can be brought in to replace them, given that there is this imperative on the part of the industries themselves and those who control them to maximize their value and maximize the profits that they gain from it. So perhaps panelists would like to comment on that.
Yeah, the reserves replacement ratio is a key driver. Companies have to replace or expect to replace the reserves that they've sold. The challenge they've got, though, is that when you could find oil, for example, at $30 a barrel, it was great. You could make money when oil was at $100 a barrel. The problem they're facing now is when you go to the Arctic and ultra-deep oil, to make $100 is costing them $120 to get it out of the ground. And so it's become increasingly uneconomic. Every new reserve barrel of oil that's been replaced is a very expensive one, and you're seeing declining margins and declining profits, which is one of the reasons why the fossil fuel industry is so underperformed in the last 5 years. It's dying a very quick death because the economics isn't working.
Thank you. Ellie?
I'd just like to comment on the point you made about the huge challenge we have in kind of breaking this dynamic of the model of the fossil fuel industry, which I think is very entrenched in the financial system as a whole, and not looking at kind of the longer term impact or the potential kind of financial impact in the future. I think this is where the disinvestment movement has a huge amount of power, because it's using people's money to really challenge that current model, and to demand a change. And I think it is a huge challenge, and I think this movement plays a really critical role in that.
Ellie, can I pose a follow-up question to that? Which do you think is more powerful, to actually disinvest or to threaten disinvestment whilst at the same time engaging? Because one of the criticisms that's made about decisions to disinvest is that when you disinvest, of course, you are selling your shares to somebody. You're selling them at a reduced price, and they then themselves may want to get a quick killing by selling it on at an increased price to someone else. So you end up with someone owning the shares that you used to have, who is actually in it for a quick buck and does not have an interest in the industry and what it's doing to the world that you would have had. So what would you say to that, Ellie? Do you want to threaten to disinvest for a while and then, as a last resort, actually do it? Or do you think there is potential for more engagement?
Yeah, I think that's a really good question. This is really a very specific argument for fossil fuel companies. I think, so I know that investors such as the Church does really great engagement work with lots of different companies to try to encourage them to make behavioural changes or changes in their business strategies. I think with fossil fuel companies, it's about completely changing the fundamental business model of a company. And I think engagement can only go so far in that. And I think particularly given that we have such a short amount of time to hold temperature rise, I don't think engagement with fossil fuel companies can move fast enough to do that. The investment movement has really taken off in the last couple of years. I don't think we've seen that really through engagement before.
Yeah, I think I think that can take you some distance. I rather agree with Ellie. I think there's the argument that Mark was making that you need just stop all the further exploration that's being conducted at the moment. We can't, even if we find it, we can't burn it. We haven't got the space in the atmosphere. So an engagement strategy could be to get the oil and gas companies to just pay out massive dividends and pay out all the money they're currently spending on the sort of these projects to just give it back to investors. But I think that fails. There are two things that are wrong with that. First of all, there are other industries that need the money. There are these renewable energy industries, some of the sectors that I was talking about, that have a need for more capital. They need to grow, and so just by engaging, you are still not helping with the invest side of the equation. And I think that's very important, and we can't lose sight of that. And then secondly, actually, just as a point of fact, really, about engagement, you don't lose you certainly still have some leverage over oil companies as a potential investor. So just by selling your stake, you don't lose all your influence. You can still have influence as a potential investor in those businesses, which I think isn't often recognized, but it's certainly true.
Because they hope to win you back.
They want you to invest. So yeah, yes. Absolutely.
Carbon Tracker's position on this is that projects which are uneconomic and not making a return on capital should be cancelled, and that's part of a process of reducing down the size of the fossil fuel industry, and that's an engagement approach, and it's project by project, company by company. Now, paradoxically, if these businesses stopped investing their profits into exploration and increased their dividends, one of the effects would be the share price would go up. And that's one of the reasons why we don't call for divestment simply, because actually what we think these is businesses which should be cashing out and returning capital to investors to deploy into the low carbon economy. So there's a more difficult argument there. But if you're a coal company, for example, who've been losing money hand over fist, there's no moral obligation for an investor to hold a company if you think the share price is going to plummet, which is what's happened in the coal industries. Investors have been bailing out just because it's a bad investment. So there's the arguments here are slightly more complicated. What I do find worrying is central bankers, and we saw Mark Carney's announcement that you can't burn all the fossil fuels, and he's quite right. Regulators are regulating markets as if it all can be burned, and there's a share placement taking place very shortly. If you read yesterday's Financial Times, Goldman's and Deutsche Bank will take around Coal India and try and place stock in the world's biggest coal company with financial institutions. And it does seem rather worrying to me is that markets are not comprehensively taking on board these risks from a regulatory standpoint, and that's certainly part of Carbon Tracker's call for reform.
Let's have some more questions. Gentleman over there, far corner.
I think we're having the wrong conversations. And especially in the wrong conversations, when I go to a lot of these events, I don't ever see people involved in the conversation who are from those countries where they're suffering the most. So I don't see people from India, don't see people from Africa or China or South America. And I'm starting to think this has become some sort of special club. My question is with regards to everyone's talking about minerals, diesel and oil and coal and stuff, but look at the whole supply chain of where the minerals come for the solar panels and wind turbines. It doesn't fall out of the sky. It comes from Congolese via China. So you've got people sort of doing slave labor for our eco-friendly wind turbines and solar panels just like they're doing for the mobile phones. But I don't see that conversation happening. So if there is money pulled out of fossil fuels, it's not just going to be the oil we're going to be losing, it's these eco-friendly wind turbines. I don't see that conversation happening.
Thank you. And another one? Let's go to the back, gentleman at the back.
Hi. First, I'd like to say thanks for the presentation. From listening to you today, what I kind of got is seems to be more of a focus on the producers of fossil fuels. So you've talked about companies like ExxonMobil and like Xstrata, Glencore, who take coal out the ground or produce oil, but they don't necessarily produce carbon emissions. It's the consumers. So it would be people who buy coal and then turn it into steel. So companies like ArcelorMittal or companies like Areva, the French energy giants who would produce energy in power plants. So my question is, I'm wondering why is there more of, or it seems to me to be more of a focus in the investment on the producers of fossil fuels rather than the consumers of fossil fuels?
Okay, and lady here, yes.
Pleased to hear. It's a quick question directed at Seb, please. And it's just that I work in renewable energy, and many of the barriers that we see to investment into renewable energy is the quick return, especially when you sort of enter into 20, 25-year PPA arrangements, for example. And it's just the question of how we can encourage investment outside of, as you say, well-structured yield codes.
Well, I mean, I think I can sort of wax lyrical about solar power in particular because, it's an incredibly democratic technology. It's incredibly scalable. You can invest in, I have solar panels on my roof. I'm involved in a project with our local school where we're getting the community to buy the system on behalf of the school. It'll then sell electricity to the school. There's abundance generation. There are crowdsourcing platforms that are investing. There are loads of ways actually that you can invest in solar by installing your own system through to community energy and then ultimately into the listed companies as well. So I think actually the the range of opportunities to invest in that sector are much broader than the traditional energy utilities where it's kind of equity or bonds really, and there's nothing else. Solar is a bit unusual because it is so scalable. Wind isn't like that at all, not really anyway. You can't easily install your own megawatt wind turbine. Geothermal, similarly. So, solar is kind of very unusual, but I think it's an incredibly exciting time, really, because there are all these new ways of investing in that particular sector.
If I can try answering the other two questions. On the demand side, there's no shortage of demand for fossil fuels, you're quite right. I'm reminded of I want to take you back a little bit of history to the Opium Wars of 1860. The Chinese loved opium. There was a huge problem with it. Hundreds of thousands, millions of people were dependent upon opium. There wasn't a demand problem, there was a supply problem. And the Emperor of China went to war with the English and the French and quite a few other nations to fight the evil disease of opium addiction. And he attacked the supply. Now, ultimately, if you remember your history, the Chinese lost both the opium wars, and Britain ended up with Hong Kong as a colony. But the opium wars did end the problem of addiction with opium. And I think what we have to understand is the similar analogy between the supply of capital to the fossil fuel industry and the overwhelming addiction investors have for fossil fuels to make money, because they know there's an insatiable demand. But it doesn't make it right. When we supply capital, it's not amoral. Investors can make and influence decisions. And in the same way, investors are now calling time on an industry which could, in the next 20, 30 years, tip us over the balance, not for 50 years, but for thousands of years. There's very clear consequences. And I think we have to take a similar approach, a similar deconstruction, a steady slowing down, contraction and reduction of the fossil fuel industry to stay within the carbon budget. I'm not against the oil industry. I'm against burning it. We should be using it for advanced pharmaceuticals. We should be using it for plastics. We should be using it for... I mean, people look back and say, did we really burn millions of years worth of oil over 100 years when we could have been using it to create some wonderful things? And that's exactly what we're doing. We need a refocused oil industry for a different sector, and that's my hope for it. On your question about the voice of people from the developing world, you mentioned India and China and economies which quite rightly have the desire for the same living standard, and I think you're absolutely right. The reason why we're having this discussion today is then the Chinese and the Indians are not financing their own fossil fuel industries. They're coming to London to finance their fossil fuel industries. And actually what's happening is these developing economies are coming to London to take investment of ordinary citizens, British pension fund members, and it's the British public which is taking on the risk of this very risky sector. And if I understood your question rightly, I think what we're trying to do is actually sort of say for what is, in a sense, the elites of these developing economies are using Western capital, British capital, to develop the industry. And I think if they wanted to develop their own fossil fuel economy, they should use their own money to do it, not people in Britain's money.
Thanks, Mark. Now, we must conclude, but I'm going to give Ellie the last words. Would you like to say anything more about any of those questions?
I just wanted to add something to the second question. I didn't hear it completely, but I think it was something around, are we targeting the supply of fossil fuels? So I just wanted to add to that, kind of following on from what Mark has said. There's a study in the Burning Question that Brian mentioned at the beginning of the evening, which talks about the way the supply of fossil fuels has really driven demand of fossil fuels since the Industrial Revolution. And I think there's a demand for energy, not fossil fuels. We need energy, we don't need fossil fuels. And I think it's in really targeting the supply, so the extraction of fossil fuels, that you open up a space for finding energy from other sources.
Thanks very much, Ellie. And I would endorse that, in fact, one needs to do both. One needs to target the supply and also the demand, and indeed the whole of the Church of England is very focused on its Shrinking the Footprint campaign, which is designed to reduce our consumption of energy and production of carbon. So thank you very much indeed to everybody who's come today. Thank you to our host, St Mary Le Bow Church. Thank you to Just Share, the organisers. Thanks in advance for the refreshments, which I hope many of you will be able to stay and partake of. And thank you especially to our three contributing speakers for your intelligent and thought-provoking and thorough exposition of the problem and potential solutions to it. Thank you.